All right, guys, we got 100 people. That is insane. I'm just gonna wait for a minute and see if Anes is gonna be around. If Anes is not around in the next minutes, we're just gonna go ahead and start. All right, so yeah, welcome, and I'm Wade.
All right, I'm back on Wade.
All right, welcome, bro. I actually got started without you, so just gonna go ahead and start the
That's fine.
introduction. All right, so
Just make sure you hit record, or
yeah,
let me see. I
get
can
started
do
that
it from.
already
No, you have
recording.
to. All right.
All right, well, yeah, guys, so welcome. I'm Wade, and I've been trading for about 4 years right now. I don't think they need a long introduction, but also started out as a neophyte and started with currencies, did currency for a while, but later switched to indices, and I've been doing indices, for the longest. So, um, all right. So today we're not going to get on the chart. We're going to go to the most important aspects of trading, the part that we all miss. Okay, and I believe after today's video, you're going to see the market from a whole different perspective. Okay. All right. So, well, we call those the trader fundamentals, and well, I think I did a poll on the indices alert, and I was asking a pretty simple question. It was like, so which one is more? Is it like the deposit or the withdrawals? And the results came in, and I realized that a lot of us we end up making more deposits than withdrawals, which is really really bad. Um, the last time I probably did a deposit might be like 4 years ago. It's all withdrawals from now on. So I've been trading full time. I got into trading. I'm gonna say I got into trading when I was 18 accurately, although I heard about it when I was like 17, 16. So, when I was 18, I got into it. So I've been trading since 18. And honestly, it's not been an easy journey, but I'm gonna give you guys all the tips, everything that I've learned, basically the fundamentals. Today, we're not doing any technical analysis. It's just what you need to know to become a solid, profitable trader. Okay. Getting the analysis, executing trades it's probably just a small aspect of the whole thing. Being able to become profitable over the long term is what really matters. So that's what we're going to discuss today. So I titled it Trader Fundamentals. And so what we want to discuss today, what we want to understand today is who is an effective trader. Well, if you search the term effective in itself, effective and efficiency, I mean, I feel like both of them are the same thing. But if we talk about an effective trader, we're looking at somebody who minimizes risk and maximizes profit for a long period of time. So I think when it comes to trading, everybody has had that experience of being profitable over the short period of time. Like one solid week, you're able to make a lot of profit. But how consistent has that been over the past 24 months? Have you seen a solid, a steady month on month growth? That kind of thing is what really makes you an effective trader. So I'm not looking at a scenario where you get profitable for today and tomorrow or like the next month, and you blow all your portfolio, or you don't start to get profitable again. That does not make you effective. When it comes to trading, you want to be as effective as possible. So just I'm definitely gonna drop this PDF, but this is the notes that I prepared that we're gonna go through. So in my opinion, an effective trader minimizes risk and maximizes profit. That's the most simple way to put it, but the short statement embodies a lot of qualities. When we say a trader is effective, it means before they take a trade, the first objective to consider is risk. How much percentage of your account are you losing? Are you entering the trade out of FOMO? Does your trade strategy permit you to take that trade? So in trade, you want to reduce losses as much as possible. Always want to keep your loss really, really low, and keep those profit really high. So, and we got 100 participant right now. So in that sense, you want to be as effective as possible. Okay, you want to utilize the right tools to make sure that your losses are low and your profit is a lot. Whenever you take a trade, there's like three outcomes. Okay, you should earn in profit, break even, or really lots of loss. Um, so effectiveness also considers time. There's the time effect when you talk about effectiveness. So you want to be as profitable as possible over a long period of time. Like you want to trade for about 36 months being consistently profitable. Not like you make profit today and you blow everything the next day. And I know not a lot of people are effective traders, but today you're going to learn how you can become an effective trader. So I borrowed a concept from accounting. I think some people are trying to come in, but we still, capped at 100 participants. Pretty sad. So, prudence concept. I got this concept from accounting. I did accounting. I have to complete my professionals. If anybody did accounting, they know about ACCA, Association of Chartered Accountants, something, something. So there's an interesting concept in accounting, and we can apply that in trading. So the concept is called the prudence concept. So if you study accounting, then there's this interesting concept, prudence concept, which states that do not overestimate the amount of revenues recognized or underestimate the amount of expenses. Also, one should be conservative in recording the amount of assets and not underestimate liabilities. The result should be conservatively stated financial statement. When we take that to trading, what we simply mean is when you take a trade, the first thing you want to look at is how much of your account are you losing? How much of your account are you risking on that trade? That is the most important thing. We don't care about a profit. That is not how we want to grow as effective traders. As effective traders, we want to make sure that our risk is the first thing that comes into hand. So if you got like $1,000 account and you take a trade, first of all, before you enter the trade, you want to see. So if I take this trade and if I lose that trade, how much do I lose from my account? That's the first question you got to ask yourself before you take any single trade. Always ask yourself, what is the percentage that I'm losing? See, when you lose a smaller percentage of your account, you can quickly rebuild that. But when you lose a bigger percentage of your account, it takes a lot of time to rebuild that. You understand? Why do we want to risk very little on a trade? Basically, because in trading, at one point you're gonna have a losing streak, and I'm telling y'all, I've had a losing streak this year. And those who were old on the indices channel, you guys can recall that when I was just trolling me like, if weight calls a buy, you gotta sell, that kind of thing. It was a losing streak for about 3 weeks. All our trades were just hitting on stop losses like crazy. So if in that situation, if I was risking a lot, okay, I would have definitely lost my whole portfolio. But I always risk 1% on a trade. If I got a lot of carriage in that trade, I'll probably risk more, something like 3%, 5%, but I never go 6% or 7 or even 10. But I see people when they start trading, they kind of yellow. It's like those huge Lambo lots, just trying to slap it on a trade and make. All right, so we're live now. All right, all right, we're good now. We got a few people wanting to get back on. All right, so that was the whole concept of prudence. When you take a trade, you look at the stop loss. If that gets triggered, if you hit stop loss, how much are you losing? And in that manner, when you start seeing the market from that kind of perspective, or when you start seeing trading from that kind of perspective, you take trades rationally. Because until a profit is realized, okay, those floating profit that you see, the screen is going to be blue, and you're going to be all happy. It's not the end, okay, because the trade can just flip and go against you, then you're going to lose everything. So until we realize a trade, it is not a winning trade, and you should be careful out there. All right, so what are the hallmark of an effective trader? What qualities actually makes a trader effective? And Well, we got to talk about discipline, and I'm pretty sure everybody knows about, most of these stuff. It's just the issue we got here right now with a lot of traders is how do you implement these kind of hallmarks, these kind of qualities? How do you implement that into your like trading lifestyle? You got to be very disciplined. If you want to excel in this market, you got to be disciplined. When you set rules for yourself, you got to follow it. Okay, if you said you're not going to trade on Mondays, don't trade on Mondays. If you said you're always going to put your stop loss at like 30 pips, 40 pips, do that. If you want to be a scalper, be a scalper. If you want to be a swing trader, be a swing trader. You got to be very, very disciplined. See, one of the interesting things about trading is in the whole market, there's just a low percentage of people who are actually making money. You understand? So you want to be part of that small percentage. And it takes a lot. I'm telling you guys, it takes a lot. And I mean, I'm going to say this over and over again, but if you start trading full time, honestly, you're going to understand most of these things. Like me, Wade, I trade full time. Every money that I make depends on this. So I cannot go on the market and like mess up, because if I mess up and lose my whole portfolio, I probably have to go work at a construction site or something, just to make money again. So you really want to be as disciplined as possible, and adaptability. So when I say adaptability, market scenarios are not the same. Okay, if this month was good for you, well, what does next month has in stock? What if next month gets so bad? Understand? What if next month gets so bad? So you really want to be able to adapt to the market conditions, because the market it is always changing. All right, this year was a pretty, I'm gonna say, kind of a terrible year at the start, because that kind of crash in the stock market. I mean, I've seen one in 2018. The market kind of crashed a little, just a little, but that wasn't so insane actually. But this one was kind of insane, and I used all my strategies, all my mental toughness, just to try and make sure that I don't get caught up in a streak of losses. But bro, no matter how hard I tried, I still got caught up in a bit of losses. So but later, I learned to get adapt to the movement of the market. So you need to be able to adapt. And I say you will never see two trading days that are exactly alike. This constant difference poses a problem when someone only looks at textbook examples of a strategy. And that's the problem with people who trade patterns. If you trade patterns, sometimes the patterns, they don't look textbook alike, right? They kind of look wonky on the actual chart. So you should be able to support that actually accurately. And emotional intelligence. So this relates actually to the side where I talk about mental toughness. See, trading is hard because you bet on the movement of price, and sometimes you're risking a lot. When a trade goes against you, you lose everything. I tell you, trading is one of the things that's really going to play with your emotions. It's going to really, really test you. Okay, so you got to be extremely emotionally intelligent, actually. And if you want to make sure your emotional intelligence is on top, make sure you using the principles of risk management. Like you risking just 2% of your account. You're risking 2% of your account. So if you get hit on the stop loss, you should be fine. Okay. And also patience. And I think this is one thing that everybody probably knows. You got to be extremely, extremely patient with the market. I've seen market that consolidated for loads of months before we actually saw a move in the market. The market can consolidate for a long time before you actually see the move that you've been anticipating. And it happens all the time. And there is this popular saying that there there is this popular saying that says that the market is engineered to take monies for the impatient traders to the patient traders. So please, you got to be extremely patient. And see, things like emotional intelligence and patience, they can be very effective if you heed to the principles of risk management. Don't over leverage, risk 2%, always use a stop loss, that kind of thing. And again, a couple of more important things that I want to talk about when it comes to the hallmarks of an effective trader. And that would have to be in the form of going concern concept. And that is also a concept borrowed from accounts. And so in account, when you say going concern concept, we mean that the business is going to exist into the foreseeable future. That means the business is going to be there for a long time. And that is how you got to treat trading. Treat trading like your business. Like you wake up in the morning, like you go to job, that is your business. Okay, that's your full job. So that's how you got to treat trading. And you got to don't underestimate the power of what you can do with trading over a long period of time. Okay, so in that manner, you're going to see trading as something you're going to do continuously for the next 5 years, for the next 10 years. Now, I see myself, I know I'm probably going to still trade in the next 10 years. All right. So in that manner, you really effectively want to trade in anticipation of the market always being there, and in anticipation of you always having working capital to trade. So make sure that when you take a trade, you are treating the whole process as a full business, and in that manner, you're not gonna make stupid mistakes and risk a lot of amounts and blow it up. And independence, and this is the thing. This is the thing with people who start trading. Well, first of all, I'm gonna tell you a story. When I started trading, well, first thing that I was interested in was somebody who can give me really good signals. So I signed up for a lot of signal services, like a lot. Okay, if we say signal services, I've been through a lot. I signed up for way too many signal services. I'm gonna see this trader, puts a couple of good trades. I'm like, bro, that trader gotta be good. I'm definitely signing up for his service. Then, a couple of months, they hit a couple of stop loss. I'm like, nah, not good. Then I'm going to change to a different signal service provider. So I was jumping from signal service provider to that. And that was a big problem. So you got to start learning how you can be independent. And independence goes just beyond ignoring signal services. It means that you should be able to do your analysis and trust in it, even if it hits stop losses. Trust in it, okay? Because when your trade hits stop losses, other people they hit it goes through, it hit a target, but that does not mean you were a bad trader. That means that you just had one bad trade that just took 2% of your account. So you want to be as independent as possible. Okay, in that manner, I always tell people do not rely on signal services. Signal service is a kind of business other people run to make money, blah, blah, blah. I don't want to get too deep in there, but I want to tell you that if you want to trade full time, please try as much as possible to gain the knowledge and the independence. All right. Don't trust in anybody's analysis. Don't trust Wade is going to drop some analysis. Well, I tell you guys that I wouldn't be dropping a lot of trade analysis on the page. I want you all to actually start learning. So I'm very independent. I don't care if I make an analysis, it hit a stop loss. I still don't care. I'm independent. I trust what I do. When I make analysis, I trade my own analysis. I don't care what anybody says. And if I'm wrong, I'm going to learn from it. I don't really try to depend on anybody, try to depend on somebody's signal. I trust what I do 100%. All right. So what are the core elements of a good trade setup? So, well, what are the elements of a good trade setup? And if you want to be an effective trader, okay, you don't just get up, go on the market and start trading just because the market is moving. Does not mean you should trade. When you make a setup, it should have a bit of elements, really good elements. Okay, so there is a lot, but normally these three are like the most important one. And the first one is it should have a good risk to reward ratio. And we're going to get on that aspect a little bit more later. So you should make sure that the trade has a risk and reward of at least one. If you take a trade and it is not one, or me personally, I like 1.5 or two because that makes you more profitable. One always almost takes you to break even or sometimes losses. So it should at least be one or 1.5. If the trade is not giving you that, do not take that trade. And make sure the stop loss is reasonable. Okay, if you're gonna trade an asset like gold, normally you don't want to put 20 pips stop loss. That is not reasonable. You're probably gonna get stopped out because gold, with our kind of annoying spikes, definitely gonna take you out of the trade. And if you trade something like the US 30, you don't want to put a stop loss of like say 100 points. You're probably gonna get stopped out, honestly, unless you try to scalp, which I'll get to scalping later. But if you're trading something like US 30, like Nasdaq is crazy. You don't want to put a stop loss of 100 points. That's when I give in. This is crazy. I like to swing them. I put a huge stop loss because you gotta give space for the trade to do what it want to do before it gets into profit and position sizing. So always use the right lot size for your account, please. I'm begging y'all, just the right lot size. I've seen a lot on a lot of platforms, and a lot of the times I'm not impressed with the lot size. That's what we discussed earlier, that you have to be trading as a going concern. Okay, something that you're gonna do for a long, long, long time. So in that regard, you want to make sure that you risk very little because you're probably gonna do trading for the next 5 years, for the next 10 years, right? So make sure that you use the right lot size. It's baby steps. And the thing here about trading is the bigger your account, the bigger the profit. And do not underestimate what you can do with a big account. I'm telling y'all, if you got an account like $1 million in your account, okay, effectively, if you make 10%, that's about $100,000. So it's just baby steps. Having a small account is a problem, but I'm gonna teach you y'all how you can grow small account. But again, the lot size. Make sure you use the right lot size, please. Again, I'm pleading with y'all the right lot size for your account. Okay. You don't want to do trading like a gamble, like you hit this trade, boom, that was good, you done. No, again, see trading as a business, something you're gonna do for a long, long, long time. And so we're gonna talk about market risk. Or so in a market, we got two types of risk basically, and you gotta know the kind of risk in a market before you take a trade. So we got systematic risk and we got unsystematic risk. And a lot of the times when we trade, the risk that we experience is, in the most part, systematic risk. So systematic risk cannot be eliminated through diversification, though it can be hedged against in other ways. Sources of market risk include recessions, political turmoil, changes in interest rates, natural disasters, and terrorist attacks. So, what do you do when the market is on its risk on settings, when the market is really risky? Easy. You don't want to overtrade. You want to risk 1%. In risky market conditions, I always advise risk 1%. So between 2018, 2019, when there was this, USA, the China trade war, trading that time was really difficult, honestly. And that time the Dow was actually stuck in a bigger range, kind of a consolidation. Um, so in that time, trading was really difficult. I'm gonna tell you, yeah, but in there, you just really had to risk 1%. And in 2018, the market briefly entered the bearish territory. So you can go on the chart, look at 2018, it was a bearish territory, that kind of thing. But in there, the market was really risky. So what I was doing is I was just risking 1% per trade. I wasn't going with a 2%. Why do I stress on the percentage? Because if you risk a little percentage, and you like hit a stop loss, you can easily make that back. But if you enter the trade and risk a lot, like if you lose 50% of your account, bro, it's gonna take you a long time to build it back up. So in a systematic risky market, you want to risk very, very little, like really, really little. And we got on systematic risk too. But, the focus is not on systematic. We just want to talk about a systematic. So there is other kind of risk in the market before you take a trade. Like normally when the market opens on Sundays, we always open with a gap risk. Okay. Well, what gap risk means is there is a gap in the market. So you want to wait for the gap to kind of get corrected before you start a trade in the market because okay, I was just going through the chart. So when you see gap risk, you effectively want to wait for like the gap to kind of get filled before you take your trade. So those are kind of minor or technical risk that you see in the market. We got price inefficiencies. They are also kind of risk in the market. So you got to know how you can trade these risks as well. And we got economic reports. But basically, for new traders, I don't really advise that you trade the news. That could be, that might probably not end well for y'all. So if you're new to trading, stay away when we got NFP, GDP, those kind of things. You just stay away from the market. Later on, when you get to understand market inefficiencies, you'll be able to trade them accurately without any problem. So risk management in a nutshell. Well, if we take risk management as a subject, okay, we're going to spend a lot of time. And that is the weakest area for most traders. Even myself, bro. Sometimes I kind of go off a little, I get too confident and I kind of go off a little. But in a nutshell, these are the three things you want to focus on. You want to focus on your position sizing. I talked about that earlier. Please use the right lot size. Don't get overconfident. Okay, just little by little. I started out little by little, and now I'm here. Not everybody. I'm gonna tell you the blatant truth. Not everybody probably gonna end up being a good trader. A lot of people are gonna stop at some point in time. But if you want to be like the big boys, okay, bro, go easy, go slow, just slow like that. So position size and don't joke with it. Always use a stop loss. Always use a stop loss. I don't know how many times I should stress on that, but please don't be like, oh, I was confident this trade was gonna go up, so I just took my stop loss off, bro. What if it went against you? Well, I'm saying this from a perspective of having a bigger portfolio, and I always think, what if one day I just messed up and I lose the whole money in my account? That's gonna be pretty bad for me, y'all. So please use a stop loss. Well, sometimes I see complaints like, but wait, if you use a stop loss, you're gonna get knocked out of the trade, blah blah blah. But if you understand liquidity graphs, liquidity runs, please don't go Googling liquidity graphs and liquidity runs. You'll be able to mitigate those kind of situations. But for the most part, please use a stop loss. If you use a stop loss and you get knocked out, you effectively lost 2% of your account, and you can make that back easily. And trade management. Okay, so trade management, we're gonna get to that. That's why I put an asterisk on that. So what is an effective trade setup? Well, we have talked about being an effective trader. Okay, so right now we want to look at what is an effective trade setup. Well, just like being what an effective trader is, an effective trade setup, okay, includes a good risk to reward ratio. It includes a reasonable, a rational stop loss position. So if you want to frame a setup, you got to make sure that setup is very effective, because I'm gonna tell you what sometimes I go to TradingView and I'll go to the ideas aspect, people posting their thoughts on a particular instrument. The things I see, it pisses me off every time, because just people just be bringing really terrible stuff over there. So we're we can define an effective trade setup as one that offers good potential returns. Good. So as I told you, a good trade setup, effective trade setup, it got good risk to reward. And I told y'all, when I get in the market, I like risk to reward that is 2 or more. And y'all know I like to swing. So sometimes I get my risk to reward. Sometimes it's about 4, 5, sometimes 6. It's insane. And risk to reward is really, really important. Don't even joke with it. I see a lot of traders talk against it, but you gotta understand it. If you want to be consistently profitable, look a lot at the risk to reward ratio. Look at how much you risk and how much you gain it. All right. If you got questions, you just feel free to ask in the chat section. And well, this part though, whenever I talk about it, it always ends up in a lot of kind of a banter, but that is the blatant truth. Never measure your account growth in pips. Never do that. If you do that, stop tonight, right now, this week. Do not measure your account growth in pips. It is not right, honestly. It's not right to measure your account growth in pips. Do it in percentages because that makes a lot of sense. Okay, see, I don't want to go deep explaining that the reason that we want to do percentages or pips. But every professional trader they do their account growth. They measure the performance in percentages. I've never seen a professional trader that looks at pips like, yo, yeah, I made about 500 pips this week. So what? What percentage growth did you get though? This is the question. That's the most important question. Okay, well, what if you made a 500 pips, okay, but you were using lots of lot sizes, so the profit was really small. Then you got one losing trade that took you out with say a minus 20 pips, but you used a huge lot size on that. Then effectively you might close with a huge pip count, but in reality your account is not growing. So please never measure your account growth in pips. I think the whole pip count then was by signal service providers because they kind of wanted to use that to measure their account growth. You know, and new traders, you know, they kind of get foolish. They want to look at, oh, how many pips you make? And I'm telling you, I was, you know, once foolish like that too. When they see that people saying, okay, we made about that's 500 pips, like 600 pips, they get all excited and immediately they take their calculators out and they go like, okay, so if you make 600 pips, if you apply the standard lot size, so that was going to be 6,000, was it $6,000? Oh, well, that sounds good. But in reality, that is not what is happening, okay? If you consider some situations, you're going to see that measuring your account growth in pips, that's not make sense. I said that measure your account growth in percentages. Percentages it's like a lot nicer. Okay, your account grows in percentages steadily. That's why most of the economic reports that comes out, they use percentages to track everything because we want to do percentage growth, not pip growth. We're not counting pips. So yeah, I'm not going to talk about that. So the reality of risk and reward. Now, our risk to reward ratio is very important, and I have heard foolish traders disregarding its relevance. It matters. If you're looking to be consistently profitable, it's worth having a solid risk to reward. And in my opinion, well, I even said 1.5. Look, bro, make it 2. Okay, 2 is always good. The problem with 1:1 is, in the long run, you might probably end up in losses. So 1:1 is like not so profitable. I'm not a fan of 1:1. At least double that. You're risking a lot, so you're risking $100. You know, at least get $200. You're risking $100, make $100. It's cool. If you're scalping, but in the long run, you really wanna take it to 2. So I like 2. If the trade is not giving 1.5 to 2, I'm not taking it. And for swing trading provides the best, you know, risk to reward ratio. So I like swing trading a lot, especially if I catch it on the bottom, if I get a dip. Who said this? Yeah, no shots fired. Okay, sure. I just want y'all to see the reality of the market. It's kind of annoying in forex trading or trading industry. It is the most annoying market ever. Loads of scammers, loads of people making money off people through fake mentorships, fake signals. It's annoying. The reality does not always show. As I'm telling you, try and be independent, okay? Make your own analysis and you're good. All right, so, oh, great. So I forgot to bring a cute picture here. I have no problem. So, we got three types of traders, and we got the scalpers, intraday, and the swing. And I kind of use this picture of this white dude looking at his phone because basically that's what scalpers do, always checking their phone. Even if they're going to the loo, they got to go with their phone because one false movement, the whole account is gone. All right, so scalpers, these guys are really wild people. But before we get started, I got no issue with scalpers. Okay, I like them. I got friends who can really, really scalp. I've seen successful traders who can really, really scalp. But if you want to scalp, you gotta get aggressive, and you gotta make sure your emotions is in check. What? My internet is good, bro. Zuvi. So scalpers typically they bank off a few pips, they get in the market and they out. And normally they use a 1 minute, they use the 5 minute time frame. So bro, I'm telling you, if scalping works for you, no problem. I don't want to be like I'm judging them too much, but as I told you, I've seen really good traders who scalp. So I like scalpers honestly. I've sometimes I try to scalp. I'm being honest confessions. I like to scalp sometimes. That is if it's in the direction of the trend. I see risk to reward for K2 is 1 to 1, so I don't know how to know if I should let all of the estates run until the end of the loss of profit. We told to 1:1, but 2 to 1 risk reward will be lower than 44% to not make profit. I rank Priestley, bro. I don't understand what you're talking about. Yeah, I know the K2 one is the reward is 1:1. It's because it's basically scalping 150 points of the Dow. So again, if you scalp 1:1, it's actually okay. Scalpers don't stay in the market for long. So if you scalp 1:1 risk to reward ratio, it's good. And remember when we started, I told y'all that with scalpers, 1:1 is fine. Intraday traders are normally they hold trades between a couple of days. Um, And normally with intraday, I mean, 1.5:1 risk to reward ratio. It's excellent. Okay, and swing trading. I say these guys are like the big boys, you know, because they like to stay in the market for a long time, and I like to do this a lot. When I catch a dip, I'm gonna hold this as long as possible. Bank off all that profit. And no shot to anybody, but when I started out, I used to scalp a lot, and scalping has kind of helped me in a couple of ways. What I'm saying is, if you want to scalp, you got to know what you're doing, because I've never seen, I'm telling you, apart from a few people who I know are good at scalping, I've never seen new traders scalp consistently, like being profitable consistently for like a year, like 2 years. For new traders, it's kind of hard. So normally I'd say when you start out, try to go intraday, okay? Use a good time frame. And again, no banter to anybody who uses a small time frame. I've seen good traders. That was this dude on K2 way back, Trippy Hendricks. I think he left, and he was a really, really good trader. And he was using a 5 minute time frame for his analysis. Uh, do you apply the K2 exit strategy in your trades? No, I don't use the K2 exit strategy, but it's a solid strategy. Um, so normally when you start out, I like to say that, try to do intraday. Intraday does not mess with your emotions. See, if you look at the candlesticks on a 1 minute time frame, well, me personally, I'm really emotional, and my emotion is going to be in a place soon. So when I see those huge candlesticks on a 1 minute time frame, I kind of freak out. So I like intraday. Intraday is really nice. You use like the 15 or the 30 minute time frame. You can frame a lot of setups. And for starting out, intraday is the best thing. swing trading, especially when you're doing indices, you can easily spot trade. Spotting trade on swing trades is kind of easy, but executing them is the problem because the market really gonna mess with y'all. It's gonna go into profit about 300 points, and it's gonna drop heavily on you, and you're gonna start thinking, I should have probably taken profit, you know. But later on, it's gonna swing back into profit heavily. So I like intraday. Intraday is like really, really excellent. You get a lot of good setups. You hold for a couple of days. You bank off about 200 and to about 250 to about 350 points if you're looking at a Dow Jones. And I'm sorry, I think I'm relating things so much to indices because that's what I trade a lot. And loss mitigation. So you see, you can get profitable in this market if you take risk management and loss mitigation seriously. So first of all, it's always three. There's three things that you gotta look. It's like when you're trying to cross a road, you look left, you look right before you cross the road. Before you trade, you gotta use this. Always use a stop loss, and this is probably like 100 that I'm saying that. Wow. So always use a stop loss. Always. You don't have to trade every day, please. Don't. As I said, the fact that the market is moving does not mean you gotta.
Your sound is again.
I heard somebody talk.
Yeah, your sound was gone for a minute. You good now?
Oh, okay. I mean, yours was actually cutting off to. All right. He's
I
turning.
think they also had a question in the chat.
All right, y'all funny. Someone said I turned into a robot. I didn't know I turned into a robot. I mean, well, sometimes it breaks up a little. I'm sorry for that. So if you got a problem, you just hit me up. I'm gonna just wait probably for my network is not 5G though. Americans and their 5G always trying to flex on us. All right, so growing baby accounts. How do we grow baby account? And I know that there's a lot of people with baby accounts. So what is a baby account? Well, if your account is not up to $50,000, you operate in a baby account. Well, theoretically, but I mean, if you got like 10K, it's fine. It's not a baby account. So if you want to trade full time, like I do, and I tell everybody you need $100,000 or at least $50,000. But I'm gonna tell you, when I started trading full time, my account was not even up to $50,000. So it's just theoretical again. If you know what you're doing, about 10K even should be fine, or 15K. The bigger the better. So 10K can be like the minimum, but even that, I've seen people blow a 10K account. So if you're trying to grow a baby account, well, I got a bit of strategies for y'all. It's not like a strategy that you're gonna apply in the market to enter a trade. It's more like trade management strategies for the most part. Somebody asking, oh great. Somebody asking, wait, Brooke, if you're hard with that statement, 50K what currency? All right, y'all. Sure, y'all. As I told you, it's all theoretical, but you want to be safe. Okay, here's the thing about trading. When you go full time, and I'm saying this because I get a lot of DMs, people asking me they want to trade full time, and I'm gonna be blatantly honest with you. Make sure that you got enough capital to trade. Okay, sometimes you can suffer a losing streak. And also, you gotta factor in your expenses at the end of the month. If like you go to the gym, you got a car, fuel, for entertainment, for clothing, you gotta factor all that kind of thing out inside. Okay, so that it kind of determines how much you gotta get in your trading account. So if you got a baby account, so these are not trade strategies; these are trade management strategies. So first, if you want to grow your account, if you're serious about trading, please have a strategy. It can be something that you've sat down to research about. I've seen people got strategies like the alligator strategy. That strategy kind of funny though. Alligator. Um, so whatever strategy works for you, and make sure that it's a strategy that at least gives you about 1:1 ratio, at least for scalping for the most part. And make sure that you understand that strategy. It's not just having a strategy. Make sure you understand it. See, when you go right now on Google or YouTube, and you can just go type like forex trading strategies, and I'll tell you what, you're gonna see a lot. You're gonna see a lot. You're gonna see so many. You're gonna get confused. So make sure that the strategy that you're gonna apply, you understand it. You understand why I'm taking that trade with that strategy. Okay, and trend trade. That is the simplest gist I'm gonna give you. Trend trade. If you want to trade a Nasdaq, always buy. That's all. And use the power of compounding. 2% per trade. We've talked about that. And I put this here. Careful with scalps. This is the issue with scalping. Scalpers. Well, I don't know any good scalping strategy, y'all. But well, how I see scalpers, they trade. They going out, in, out, in, out, in, out. Bro, why don't you buy at the corrective swings? They're gonna go in and out, in and out. It's kind of scouting is kind of stressful in my opinion. Okay, because bro, you literally gotta open your eyes and watch the trade. Every point matters. So I told you one mistake and your account is gone. So if you're trying to grow a baby account, I'm not saying don't scalp. I'm just saying be careful with scalping. And just because it's scalping does not mean slap a Lambo lot on that scalping, but still be careful. All right. Zuvi, I see you, bro. Signal service, again, if you want to start going full time and like trade on your own, be careful of signal service. And I know people are gonna come at me because of K2, that kind of thing. Well, K2 is actually good. K2 signal service is good, so you're safe. But a lot of the signal service providers, what I know, they don't even treat the signal that they send out. They just send stuff out to you. It's like, it's funny, y'all. They just send stuff out to you. They're not taking it because they don't want to blow their account, or they probably don't think the trade is good. So they're just gonna send it to y'all, because you paying them money, you trusting them. But a lot of the time, the things that they're gonna tell you to do, or the trades that they're gonna tell you to take, it probably gonna blow you. They don't care, all right? Signal service providers, a lot of them, they don't care. And I'm not saying all signal service providers are bad. I'm just saying 96% of them are bad. Only 4% are good. And I think, whoa, who is saying finally something positive about K2? Bro, I'm part of the team, y'all. And long-term growth, as we said earlier, look at the business as a long-term thingy. And my biggest advice, if you want to do indices, okay, swing trade, buy on the buys. Okay, if you get a good buy setup, just try to swing it to a big figure. And my boys know what big figure is. So I want to talk about compounding actually. I'm probably gonna go here. So other people, when they start trading, I tell y'all, well, we're gonna get that soon. But I like to tell y'all to either use 25% per month, or like I do, I like to use 44. Oops, 44. So let's say you trying to, start trading, and you want 44 is actually easy to make. Okay, no bragging, but it's quite easy. So you run like a 2-year project. I don't like to look 1 year because I told y'all long-term plan. Oh, Aaron is here. So I'm gonna put just $2,000 over here. It's like at least everybody can afford $2,000. If you can't get $2,000, just hit Zuvia up. He just gonna give you $2,000. I'll put probably about 25% start. So if you run up $2,000 and what you just want to make, 25% is easy. Bro, I see people looking to make 100% on their account. Bro, just chill, okay? It's good, but you're just gonna stress yourself out. You don't want to flip an account. In here in trading, we don't flip account. We grow them exponentially. So 25% is easy. You're doing $2,000. You want to grow it in 24 months. That's like 2 years without making withdrawals. And you can make close to, $500,000 and $500,000 in 2 years from $2,000. Probably they're gonna hire you at one of the Wall Street banks because you are gonna be really respected. Most of the investment firms out there in the United States, I know they give about 3 or 4%, 3% like that. Yeah, so something like that is what you're gonna make because they don't give a lot of percentages out. I see investment that give us little less 2.5%. So if you're trading for yourself, I mean, like, bro, you're your own boss, so you can just give yourself 25%. I give myself 44%. I try to make 44 every month. So 25, you run up on a $2,000 account in just 24 months. That is good. Well, let's see what happens if you get 44. Yeah, don't laugh. You're gonna make $12 million. That's it, $12 million. And it's all just theoretical. All right, but yeah, you're gonna make. I mean, who doesn't like $12 million? That's really sorry. We can get all the Lambo, the yachts, all that. All right. So debunking trading myth, and we're gonna get really quick on this one. First of all, there is no holy grail strategy. Let that sink in. All right, just take a minute. Just take a minute and let that sink in. There's no holy grail trading strategy, and that is why you don't have to move from strategy to strategy. When it comes to forex, there is a lot of strategies, like way too much. There is nothing like a strategy that's effective than the other. Most of them obviously got like the same winning percentage. So you don't want to move from strategy to strategy. Oh, using a strategy, there's an alligator strategy. I know there's a cat strategy. There's a dragon strategy. Um, there's a lot of strategies, guys. You can just Google them. You're going to see a lot. And there's no Holy Ghost strategy. But something that is close to the Holy Ghost strategy probably going to be price action. So if you want to focus on anything, at least focus on price action. And and if you want to do price action, yeah, price action itself recently is starting to, get distorted. But when I went to, there was this online shop where they sell trading indicators. So I was there one. Don't ask me what I was doing there. And I saw an indicator called price action indicator. I was like, whoa, y'all, they are just, doing it too much. How can we get an indicator for price action? So you just see that it's just all distorted in the price action. So if you do price action, make sure you do it right. You don't want to do price action and be finding cat patterns. I've seen cat patterns, dragon patterns, or you don't want to get on that side. At least learn price action. It's the closest thing to the holy grail. And trading is not instant wealth, y'all. It took me about 24 months to actually get a lot profitable. And every time, every day you learn, every day you get better. Okay, when you start out in trading, okay, listen, everybody here, if you start out in trading, you want to learn. That is the best way you can become profitable. You don't want to get instantly rich because it will not work. It's going to take you a long time. But I tell you this, if you stay focused, and the word here is focused, like very, very focused, in 6 months, you can be pretty good. And even that, you're going to now need experience. So it's not a joke in this market. So yeah, more indicators are better. You know what? Just like too many cooks spoil the broth, too many indicators may end up confusing the trader instead of showing him the right direction. So here we go. I'm not against indicators. Some indicators work, and K2 indicator trading on the momentum is a solid one. So don't go after indicator after, because there is a lot, as I told you, there's a lot of strategies out there. So if you want to go trying to find what works, you're going to go and go and go and you're going to get lost. So do not chase after indicators, y'all. So please don't chase indicators. And more pips means growth. We've talked about this, okay? More pips does not mean growth. I tell you, you can have 500 pips and not really make anything in your account. And you can probably make about 100 pips and make a lot of profit. So I don't even want to hear the issue of pips again. We want to make pips, obviously, but we don't want to count pips, or we don't want to measure our performance with pips. So we got like a 4 or 5 slides, and we're gonna get them. So framing high probability trades. Before you execute a trade, you gotta ask yourself a lot of questions. That's why I don't like the idea of chasing after signal, because when somebody gives you a signal to buy, and that is including me, when I tell you to buy or sell, you don't know what I'm saying. You don't know why I'm saying that. You don't know if I'm going to be right or if I'm going to be wrong. You just trust in my historical data because I've been giving good trades, so probably weight is always going to be right. Well, trust in the weight, but you know what? You also got to know how you can frame your own trade. So before you frame out a trade, and there's just only low fraction of the things you got to ask yourself. You got to ask yourself, so what is the institutional order flow of this asset? Does this trade offer good RR? I tell you, if any trade does not offer good RR, do not take it. In the short term, again, we got two things. In the short term, it'll make you profitable, but in the long term, it will not make you profitable. So if a trade does not offer good RR, do not take it. Again, unless you want to scalp. And I tell you, I forgot to say this, but scalpers, sometimes their risk to reward ratio is 0.5 is to 1. That means they're risking a lot of losing side. I mean, they're willing to lose more just to gain just a little. So, scalpers are wild. I always say scalpers are really, really wild. Okay. And you just gotta know if there's a major economic report like this week is NFP, so I'm just gonna be very careful. Or any other form of systematic market risk, you really want to stay away. And also you gotta ask yourself, is this trade a swing or intraday, that kind of thing. Just gonna ask yourself that. So a brief talk on trade management, and the first one is, do we have Marcus around? I don't think Marcus is around. Well, the first one though is, don't break even too fast. So here's how I trade. I'm just gonna give you a little preview of how I trade. When I take a trade, first, I used to move my stop losses too fast. Like once I see profit, stops to entry, and I do that because I'm scared that I'm gonna lose those profit. And you're actually gonna ask yourself, well, see, if a trade is in profit about, in this is if like we in profit about 50 points, and if you move the stops to entry, effectively when you get knocked out, you close with 0 points. Okay, but what if you took profit at the 50 point? That would have been good, right? Well, again, you might probably be exiting the trade too fast. That's why you need to make sure that you can analyze the market very, very well. Only when I take a trade recently, when I take a trade, bro, stop loss, first target, second target. First target normally intraday, second target normally can recall if you said this. Will you be sending the PowerPoint presentation after the webinar? Sure, I will. Oh, your friend lost FTM 7 times because anyway. So don't break even too fast. Okay, break even is good, but when you take a trade, these days, those are how I trade. I'm gonna tell you how to trade. When I take a trade, should hit stop loss or should hit profit, because I'm literally risking 2%. So if I get taken out, no problem. I love stop losses. They're part of the game. See, this is the time where you start to love stop losses. They're your friends, okay? They're your buddies. And one day you're gonna hit them. So start embracing them, start understanding them. If you start understanding them, you're probably not gonna hit them a lot. That's why you need a good trading strategy, y'all. So don't break even too fast. These days, I don't even move stop losses to entry unless I'm selling or unless it's a risky market. Other than that, when I take a trade, it should go to the first profit, at least the first profit target, or it should go to stop loss. So the moment it gets into a little bit of profit, I don't just move the stops to entry. Because one thing about getting knocked out of a trade, the moment you get knocked out of a trade, now you start to ask yourself, ooh, do I oh, we got Aaron in the building, y'all. the moment I get like, I kind of get knocked out of a trade, you start to ask yourself, so can I enter this trade again? Okay, can I not enter this trade? And sometimes when you break even, it's good because the trade is going to hit stop loss anyway. So you start to think yourself, well, that was pretty good. That was a close one. But think of the many times that you have lost good trading opportunity because you got silly and you move your stop losses to entry way too fast. So you don't want to break even too fast. When you take a trade, unless you're scalping, there's always an exception for scalpers because they are the market elite. So don't break even too fast. When you take a trade, stop loss or target. That is your target. That is the main thing that's supposed to happen. King's here. You are only you, because I think everybody can hear me, bro. Take partials. Okay, so when I say until a trade profit is realized, it can get back in losses. Multiple entries. Why you say take 2% trade? Does not include the multiple entries should equal to 2% or each entry is 2%. Okay, that is a pretty good question. We're gonna get there. So yeah, I want to read this question out. It says when you say take 2% per trade, does that include the multiple entries should be equal to 2% or each entry is 2%? So well, each trade should be 2%. Yep. Each trade should be 2%. So if you take like 3 entries, then you basically risking 6%. So that would be a lot. So if you want to take multiple entries, make sure you risk 1% and make sure at least you run in about a 3 or 4. Again, there is a lot of exception because like me, I'm different. I know what I'm doing, obviously. So I can't, do my thing. I can risk about, as I told you, I don't go about 10. So I can risk about 8, really high. I can risk about 9 or 9.5. But for you, I just, keep it low. Your max should be at least 5%. So the total trade and everything running should be at least 5%. But for each trade, if you're going to take multiple positions, make sure that each position is 1% and make sure you get 5 entries at most. Also, make sure that it's in line with your risk appetite. Okay, if you can take a 5% hit on your account, do it. And so take partial profit. So for new traders, I mean, I was getting that kind of question a lot. Like, it's not easy getting your emotions in check, having to watch your trade, climb into profit, then come back a little. So can't you just take some profit? So until the traders realize it can get back into losses. So always take some partial profit. You know what? You just take some partial profit, then allow the trade to run. So normally if you take a trade, if a trade is supposed to hit stop loss, it will hit stop loss. So if you take a trade and it does not really get to the target, all right. So if you take a trade and it does not really get to the target, at least you can bank some partial profit. It is fine. It's accepted. If later the trade gets back in a stop loss, then that was a losing trade. At least you took some profit to kind of hedge the loss. But if that trade ends up going into full profit, then, good one. Be careful trading correlating assets. Like indices, for instance, right now, we got to know, or I've always known that indices move in the same direction, but right now, the NASDAQ is like way off, like really, really off. In that manner, you want to analyze them separately. You don't want to, because the NASDAQ goes up, so the Dow going to go up. Well, take a look at the chart again. Then one more time, risk 2%. Always risk 2%. Always, please. I'm begging you. I don't want to hear an issue like, bro, I blew my account 2%, please. So some kind of projected matrix. Always make sure that like your minimum, it's supposed to be maximum, not minimum. Always make sure that like your minimum drawdown is 15%. And at least 25% per month is good, and 2% on every trade, and minimum at least for scalping, 1:1. It's the minimum, but it's not the recommended. If you want to know my recommended, you should risk 2:1 is a lot better. That's what I recommend, but the minimum should be 1:1, y'all. Okay, we almost getting done, y'all. So lastly, just a bit on trading psychology. So, gotta delete this. So in trading, the psychological part is the most important one. And in here, well, if you have not read Trading in the Zone, please go and read it. It's the best book on trading psychology ever. I cannot even talk a lot about trading psychology. So please make sure you get that book. So effectively, you want to get objectives. When you trade, you want to get objectives. Why are you trading? See, I'm telling y'all. I know that we all want to do stop the 9:5, working, but apart from stopping the 9:5, you got to get a solid reason, a solid purpose for trading. Why am I trading? Yeah, you want to, financial security, that kind of thing, but also you should probably be like, well, I want to understand economics. I want to understand how the market, it kind of moves, it kind of reacts, those things. That is what will create the interest. If you want to trade solely because you want to make money out of the market, well, you got to start being careful. Okay. And fear. You don't have to fear in the market. We talked a lot about risk management. If you take a trade, you risk the right amount. All right, so we're back. So we were talking about the trade psychology, and check something. I think a couple of people want to be inside right now. All right, great. So hope everybody can hear me right now. We got 2 more slides. I know a couple of people want to go, but let's just wrap this up real quick. Market open, so let's just check a couple of things. So objectives, as I told you, you got to get objectives when you trade, and emotions. So this is actually a tough subject. Like, how do you keep your emotions in check? That's why I recommend you go and read that book. Okay, I cannot talk a lot, but you gotta keep your emotions in check. That's why you gotta use good risk management. If you know that you're just getting knocked out 2%, then you're not really gonna let your emotions rule over the trade. And also sometimes, for real though, we get our losing streaks. That actually messes up with our psychology. So when you get a losing streak, what I like to do is I stay off the market for like a week. Normally you're probably gonna go to the beach, get closer to nature, that kind of thing, just to, get over all that loss. All right, so so that'll probably be it for all. Oh, that was the last slide. So yeah, if you got questions, you just let me know. And thanks for coming. I just wanted us. I don't know if Anas is gonna make a market overview. Personally, I don't think we got a lot of time to go over the market. So that is all, guys. I want to know if you got questions. You just let me know, or if what we talked about kind of made sense. You just let me know all that.
All right, guys. So now it's the time. If you have any questions for Wade, to ask him anything in regards of the presentation, anything that you would like further clarification on, or anything. I did also prepare not the PDF format, but like I prepared presentation via PowerPoint. So a few things are going to be like cross-keyed, like the topics that Wade covered, but there is few
Okay.
differences. So if you definitely want to stick out, I think you will be, glad you did. So just want to like give you also my perspective and feedback or anything. But right now, definitely go ahead, unmute yourself or type in the chat any questions that you have. And later tonight, I will be recording the market analysis, and that will be posted on YouTube as well in the Telegram channels. Go ahead, guys. Okay, we have question from Mo. What would be the best tools to use for analysis? I mean, it really depends on what strategy you're applying. I mean, Wade can give feedback on what he and demand zones that I draw around the key levels on the weekly and the daily time frame. As far as the resistance and support, if you followed any of my webinars or any videos that I made about the market overview, I switched from the candlestick to line charts to identify the sharp points in the chart, which signify like very key and reversal points in the market, where price is likely to have a rejection in the future, looking at its previous historical reaction off of it. There's multiple things that can be used. It really depends, like what is your level of as far as the forex trading. We can discuss that more into detail if you wanna bring that in the Telegram, so that we can make sure we guide you the right way, and not like start immediately with like advanced analysis. So it's multiple things that play the role. Like price action is definitely, like Wade mentioned, the best way to be successful long term. Learning Japanese candlesticks and their formations, how to identify them, where to look for their formations. Just going off of simple things like double bottom or double top, that doesn't work. That is just one of the things that is used as a confluence and confirmation with other things to enter the trade. But using that like
Bro, you cutting off right now.
just wait, if you have anything to add, go ahead, and then
Okay, so I
I'm
see
gonna identify next question.
what time frame is best for the US 30 intraday? Well, if I like to do intraday on the US 30, normally I like to do top-down analysis. So what I'm going to do is I'm going to switch to the weekly, try to find my bias. I try to find if we on an impulsive or a corrective swing. When I do that, I find my bias on the weekly. I'm going to go on the daily. Daily mainly for swing entries, look at big figures, mid figures, that kind of thing. And if I want to trade, just bank off a few points intraday, as you're asking, it's worth switching to the 1 hour or the 30 minutes time frame. They provide the best trading opportunities. You want to swing from big figure to mid figure or mid figure to big figure, something like that. So for intraday, just get your bias on a bigger time frame, like the daily or the weekly, then switch up to like the 30 or the 50 minutes time frame.
Okay. So we have the next question read by Miss Teresa or Teresa. Sorry if I know there's two different pronunciations. So if you use weekly and daily time frame for markup of support and resistance, which time frame do you take the trade on? So this is two-way question, right, that you have, and this is why. So to actually answer directly, like I entering the trade, I enter on a 5-minute chart, meaning I change my chart on my MT4 to 5 minute, and I enter on the open of the 5-minute candle. That reduces like significantly, not significantly, but reduces the drawdown by few pips. That is one thing that usually people don't know about, and you don't really hear it a lot. But I read it somewhere and I actually tested it out, and it does make difference, like 2-3 pips, not like a major, like I said, but it really does help. But identifying the entry, it's usually on the 4-hour or 1-hour close. For example, if it's, let's say, if it's let's say the pair is in the uptrend, right, and it's been trending for a while, and then you see exhaustion on a higher time frame, meaning it's hitting like key supply zone and key resistance zone, whether it's on weekly or on the daily, and then you see loss of bullish momentum. That tells you a few things. Number one, tells you that the long-term buyers and people who were in a swing buy for a while are probably taking their profits, and that's why you see reduction in that buyer's volume and pressure, right? And then you don't enter the trade as soon as the price reaches that point. You look for confirmation via rejection, right? If there's like a 4-hour candlestick with a huge wick that wicked out of that zone, meaning the price is resisting to go higher, and then you look for what kind of candlestick is forming there. Like, do you have evening star, formation on a 4-hour or 1 hour, preferably on 4-hour, because that is one of the strongest candlestick patterns, and it's a really good let's say insight in what is most likely to happen next. And then once you see that, you look for the entry on a higher time frame. Then you right after that 4-hour candlestick close, you watch next 1 hour or maybe 30-minute candle, just to see if that rejection now attracted a lot of sellers in that market, right? Are we now reversing the trend, or we are due to a huge retrace? So maybe we can catch that corrective wave. And you see that on a smaller time frame, like I said, 30-minute or 1-hour charts. But you want to make sure that you see the sell pressure and volume coming into the market, so that you can jump on, not immediately and prematurely entering just because that is supposedly the key zone, and price is just going to reject it. You don't want to just trade what you think will happen. Like, you always trade what market presents to you and what you see.
Yeah, it makes a lot
So
of
I
sense.
hope, Teresa, that helps and explains a little bit.
Yeah, that makes a lot of sense.
Misbah here, welcome. Slava FX, hey, what's up? Was a pleasure to start week with you guys. Time for sleep before. Thank you. Okay, well, have a great night. Thanks for staying up. I know it's late over there. It's probably 1 a.m. over there now. So yeah, get
I
some
think it's
sleep.
12
And
a.m. in London.
oh, it's midnight.
Yeah, pretty much. Yeah, it's midnight in London.
Okay. Oh, it's 2. Oh, okay. Well, yeah, definitely get some sleep. And I mean, another thing, like, closes first daily candlestick, just to see how market reacts on multiple things, right? Was there any like fundamentals or major announcements, in a world economy, or any, let's say, international tensions that can possibly cause some moments in the market that you can't really anticipate. So it's just good to like sometimes observe and not just like have this urge to enter the trade as soon as the market opens. So best days to trade is definitely Tuesday through Thursday, starting Tuesday London. But like I said, I do usually, find good setup on Monday evenings during the Asian session. Kenton says 12. Okay, Germany 1 a.m. Okay. Okay. Good night to you too. You guys have. Yes, Mateus. Hit me up on the Telegram, and I'll send you a good selection. Mayank has a question. What do we need to pay attention during NFP week? So NFP week. So I can probably record one short video about the NFP and how I trade it when I trade it. So NFP is actually it's something that you can calculate beforehand, right? It's composed off of the 4 reports that actually come out during the previous month, and so that is like manufacturing. PMI, non-manufacturing PMI, ADP report, and there was one more. What was the fourth one? I have it written down, so I'll probably just make a video about it. But like using the data from those four reports, you can pretty much estimate what NFP would be before it before it's actually released. I'm not saying that it works 100% of the time, but it really works well in anticipation of actual NFP report that comes on every first Friday of the month. And I do believe if the month has, let's say, 5 Fridays, sometimes NFP release falls on the second Friday of the month. So let's say if September 1st is the Friday, it most likely there's a chance that it will be released on the September 8th, if that makes sense. T-Boy, yeah, I have a lot of material I can send you. It's just what you will do with it. I mean, not to put you on the spot, but like anybody, like I'm always glad and excited to see when people want to learn. So I'll definitely send you good material. You just have to put in the work. That's it. Teresa, yeah, just hit me up, guys, on the Telegram, and like I said, later on before I start market overview, I can send you this. Yeah, it's 4th of September. Let me check the calendar. So yeah, because it's 4 Fridays in September. No, hold on. Are you sure? Hold on. Wait, where am I looking? I was looking August. Yeah, because it's 4 Fridays in September. That's why it's going to be on the first Friday. So you are right. It will be on the Friday, the September 4th or 4th of September. So is it sensible to trade and get into that kind of risk? So if you are not experienced with trading NFP, I would say don't do it. Just because, I mean, I would say don't do it. I was gonna say you can set like, let's say $100 aside. And if you have a good feeling about taking certain trade, let's say, if you're confident in USD strength, then you can probably look to sell gold or, GU, EU as well. But like, I wouldn't just, try to gamble with it. Like, let me just, try to predict this. No, you should have some research done prior to doing that. And not just blindly go in it, because might as well go to casino. You'll have more fun and it will last longer. Ejiro Akpur, sorry if I didn't pronounce that right. Ejiro, do you have signals on FP days? I mean, K2 signal. I'm not sure if Sean sends signals on NFP. I'm gonna say pretty sure he doesn't, just because there's a huge risk associated with it, and especially during that time, he usually sends his US30 signal. So that wouldn't be a good idea, to be honest, because yeah, that can just spike crazy. And yeah, definitely avoid USD pairs. Well, if you're going to avoid USD pairs, then you shouldn't trade NFP, because NFP is, mainly impacting USD movement. That's what NFP is about. If you're holding any trades from last week, should we close? I mean, what are you holding? I was holding EA. Let me actually check on it. EA, we had stop loss in profit. Let me see. Oh yeah, EA, Euro AUD, we're still holding sell. It's currently up 100 pips. It has 60 more to go. Yeah, final TP is 161,100. Yeah, EA is still holding. Stop loss should be at 1.6200 to secure 70 pips. And as soon as we get break below 1.61500, we will move stop loss deeper in profit. CMC. Any other questions? If you guys don't have, then I know some of you are already tired,
Yeah,
but
we had a
I
pretty
will
long
definitely try.
session.
Yeah, I will try not to drag it too much, and be straight to the point with my part. Let's just see if we have any questions. Okay. All right. Well, Wade, if you can give me back host so that I
All right,
can
sure,
share
bro.
my screen.
Definitely gonna go ahead and do that. Okay.
All right.
You're the host now.
Um, all right. Okay, so let me just make sure we don't have any more questions. Wait, can you just watch for me if there's any question?
There's no question. Oh, okay. I'm getting somebody asking, what's the minimum
What's the
account
minimum account balance to
to
trade
trade
US30?
US30?
I think, yeah.
To be safe, depends on your broker because every broker got like a different contract size. But to be honest, bro, you need about 5,000 just just to be safe. Honestly, it's crazy volatile, and I don't know where you at, Matthias, but if you can use AvaTrade, probably you can do $2,500 because it's not as crazy volatile with AvaTrade. But if you look at other brokers, actually like IC Market, um, Hugo's Way, Card for X, that one is crazy. So you need a lot of money.
Yeah, well, Wade just said 5,000. I was going to say if you guys do have Hugo's Way account, you can probably do it with the 3,000. Just admit people, you can probably do it with the 3,000, but you do have to have some prior practice trading US30, so that always you want to try avoid, large drawdown, and just, find a decent entry,
Yeah,
because
definitely.
like Wade said, yeah, it can move crazy. Okay, so like I said, I'm not gonna try to hold you guys too much because we'd already covered most of these topics. Um, one thing I just wanted to say about the risk management, I definitely agree with what Wade mentioned about the 2%. As you see here, you guys can see my PowerPoint, right?
Yeah, definitely. We can see that.
Okay, yeah. So I did mention here 2 to 3%, and I also did mention, the forest risk guide for the major and minor payers. It's if it helps you to calculate this, 0.01 lot size per $100 in a trading account. So now you have to also take into consideration if you are opening more than just one trade, right? So now that results in 0.02, 0.03. So what that does, that increases this risk here, right? So if your stop loss is 20 pips, right? And that means you're already risking 2% of your account. And by opening more trades at this same lot size, then you're increasing your risk. So that's something to be mindful of, whether you're willing to do that or not. But it's definitely, suggested not to do that because like you want to focus on growing your account at reduced risk, right? And another thing that I would say, like, Wade made the suggestions, and address the baby account. I would definitely say before you actually go live, first of all, practice on the demo account. I know a lot of people will tell you that, like, it's not the same. Like, it's different on demo account. You just always somehow happen that you do better, this and that. But like, that is very practice habits, right? Don't focus on the money gain and how much you make, but try to practice your trading plan, right? Try to you have to have a plan. Like Wade mentioned, it's best to do percentage of the account growth, whether that's 5% a day or a week. I would say try to stick with like the monthly percentage like Wade is doing, because if you set your plan and you say, oh, I have to grow my account 10% every day, so now you're binding yourself that you have to trade every day, because you're in your mind, you're thinking, I have to get this 10% today. But that causes you to force trades, right? You don't force trades. You wait the market to present you with opportunity to enter the good setup and good investing opportunity, rather than saying, oh, I have to do this 10% a day. And by allowing yourself to do it, to have a plan for the monthly percentage growth, you will most of the time exceed it, because sometimes you will have amazing weeks where you can possibly even reach your monthly goal in a week, right? We have question by Eric. What is the... So so if I'm, let's say, entering the trade with 1 to 3 risk reward, right? And I'm aiming for, let's say, 150 pips, right? So, and my trade goes in profit 50 pips, right? I'm going to move my stop loss in profit 10 pips, right? So that way I'm still allowing 40 pips drawdown, a room for my trade to develop more, right? Instead of me just like, oh, okay, well, it already started going my way, so let me just let it go. And but that can also cause a lot of losses, because you can go to sleep and next thing you know, you wake up, oh wow, it turned all the way around and hit my stop loss. So now the profit that you had, you gave it back away. So I would say always try to secure some profits, but don't make your stop loss too tight, right? Because like that is perfect opportunity for the market makers to get you out of the trade. Definitely. Because they can see they can definitely see where we place our stop losses, and they will just throw random spike, not even price going to reverse, just the wick of the candle will take you out. Just next thing you know, you see the trade has reached the full target that you were initially aiming for. So I really don't like me personally, I don't move stop loss at entry once my trade goes just 20 pips in profit, because that's that just doesn't work. You need to let the trade develop and have confidence in your analysis and your the setup that you took, and always try to have insight in what trade you are taking, and question if you see let's say some signal, and they tell you to sell this, buy that, just ask them, hey, why are we selling this? Why are we buying this? You know, and also look at it yourself. You know, see what the person says, and you know, see if that makes sense. If that's, you know, enough reasoning to enter that trade. But if you are trading on your own, you know, just have a confidence, you know, and give the trade some room to develop. So I hope that helps a little bit. Arc or air, yeah, Arc, I would say. Okay. All right. So next thing, you know, we wanted, like we'd already addressed it, but I just wanted to give a little more, you know, from my side is about the loss mitigation, right? Mitigation just by itself is, you know, attempt or action to reduce, you know, like possible losses. I mean, here, this is just the pure, you know, definition of mitigation. It's action of reducing the severity, seriousness or painfulness of something. In this case, that would be, you know, reducing possibility of, let's say, losing half of your account on one trade, you know. And how can you do that? It's by over leveraging, right? That's the best way to lose half of your account. And especially if you are trading extremely volatile instruments like indices or gold,